If you think all whole life insurance is the same, it's not. And if you've never heard of mutual whole life insurance, you may be missing one of the most powerful long term wealth tools still used by financially savvy families today. My name is Alex Gross, owner of US American Insurance. I've been in the insurance business for over 6 years, and I spend a lot of time educating people on how life insurance actually works. Not just the basics, but the strategy behind the products, the companies, and how to use them correctly. If you're here to learn. And today I'm going to break down one of the most misunderstood and most exclusive types of life insurance in the marketplace. In this video, I'm going to show you the difference between traditional whole life and mutual whole life, why mutual whole life can be so powerful when structured properly, how dividends and paid up additions work, and a real example of how a policy can continue to grow even after premiums stop. Let's get into it. So first, let's start with what most people know, traditional whole life insurance. Traditional whole life is a permanent life insurance policy. That means it lasts your entire life as long as premiums are paid. It typically has a level death benefit, a locked-in premium, cash value accumulation, and generally an income tax-free death benefit to beneficiaries. And this is under current tax rules. You don't want to put your beneficiary as a trust. That is how it will get taxed, but that's for another video. For many people, traditional whole life is used for funeral expenses or final expenses, small estate needs when wrapping up an estate, or leaving behind money for bills so the family isn't burdened, right? No one passes on the first of the month, not typically, so there's going to be some leftover there. A lot of these smaller policies, sometimes 10,000, 25,000, or even 50,000, are what I call pocket policies. And honestly, I think most families should have some version of this in place so there are no surprises at the end of life. So traditional whole life does have value, but that's not what this video is about. Now let's talk about mutual whole life and why it's different. Mutual whole life is also permanent, it also builds cash value, it also has a locked-in premium, and it does pay a death benefit. But here's the key difference. The policy is issued by a mutual insurance company. That matters because in a mutual company, policyholders are not just paying customers. They are participating members, and eligible policies can receive dividends. And that's where the power comes in. There are only a small number of true mutual life insurance companies left in the US, which gives you a clue how specialized this space really is. It's about less than 25 that actually even provide this product on the life insurance side. With a participating mutual whole life policy, the company may pay a dividend each year. And this is important. Dividends are not guaranteed. However, if you take a look at the track record of any mutual life insurance company, they have paid a dividend out every single year for the past 100 years. However, they do switch, change, increase, decrease, especially, for example, during the pandemic when COVID was happening. They paid out a little bit less dividend, but they still paid a dividend. Point being, dividends aren't guaranteed, but they have been happening for the past 100 years. When a dividend is paid, you usually have options. You can often take it in cash, use it to reduce your premium, leave it to accumulate, or you can do something which is called reinvest it into the policy using paid up additions. This is why paid up additions matter. Paid up additions can increase your cash value and also your death benefit. And this is where mutual whole life can become very different from what people picture when they hear whole life. Instead of a policy that just sits there, a properly designed mutual whole life policy can become a policy that continues compounding and expanding over time. Let's talk about something people always ask about when it comes to whole life insurance, and that's called cash value or the access to it. With many traditional whole life policies, if you borrow against the policy, you're taking a policy loan. And if that loan is not repaid, it can reduce the death benefit paid out. That's one of the reasons policy design and company choice matters so much. With a properly structured mutual whole life policy, especially when using dividend options like paid up additions, the cash value and death benefit growth can behave very differently than a basic final expense whole life policy. And this is not just small burial insurance with cash value. This is the most important takeaway. This can be a much more strategic long-term financial tool when designed correctly. And yes, the exact numbers and mechanisms depend on the illustration, company, and policy design. I'm going to show you one here in a second. Now let me show you why people get so excited about this. Let's use an example of a young 20-year-old male on a 10-pay life policy. First, what does 10-pay mean? It means that premiums are paid for 10 years and then the policy is fully paid up. No more out-of-pocket premiums are required after that. Let that sink in. You pay for 10 years and the policy will continue to grow and be in effect for the remainder of that individual's life. So what happens after 10 years? In this example illustration, after the year 10, the premium stops, but the policy can continue to grow, the cash value can continue to increase, and the death benefit can continue to increase again, depending on dividends and policy design. And this example, paid up additions are put into effect. And this is the part that most people have never seen before. I'm going to touch on this because this part is very important and I want to be clear. When you look at a mutual whole life illustration, you'll usually see guaranteed values and non-guaranteed values, and these are based on dividend assumptions. Guaranteed values are values the company is contractually showing without assuming future dividends. Non-guaranteed values are projections that assume dividends continue at a certain level. Again, dividends are not guaranteed. They are dependent on the company's performance. But once again, that said, mutual life insurance companies have a long history of paying dividends, but the amount can go up or down. So when I explain the upside of these policies, I always want people to understand the difference between guaranteed and projected values. This is very similar to the IULs or index universal life products you've probably heard about. But the difference is, again, this is a mutual company that pays dividends regularly. They have a track record of doing it for the past 100 years. I don't expect it to change. IUL is a different beast, and also for a different video. So this is why mutual whole life can be so valuable for younger people, children, and long-term planners. It is permanent coverage. It can build accessible cash value over time. It may grow with dividends and paid up additions. It can be designed to be paid off in 10 years. It can also create a long-term asset that continues working later in life. For example, by middle age, a properly structured policy may have meaningful cash value that can potentially be used for opportunities, emergencies, or planning needs, while still keeping life insurance protection in place. And later in life, it can become a major part of estate or legacy planning. For example, a lot of people like the benefit of life insurance, such as living benefits. These have living benefits too, except they're going to make sure they're there because it's a whole life policy, unlike term insurance, which you may outlive because it terminates eventually through that time period. So if you start this early, it can be very powerful. So who should look at this? Mutual whole life is worth looking at if you have a newborn or a young child, you have a grandchild you want to set up with something powerful early, you're under 30 or even 40 and want a long-term strategy, you want permanent coverage with a stronger long-term planning angle, you're comparing basic whole life versus a more strategic policy design, or you're also looking for some tax advantage programs. This is not a one-size-fits-all product, but for the right person, it can be an incredible tool. So that's the snapshot. Traditional whole life and mutual whole life are not the same thing. And if you're only looking at the premium and not the structure, you might miss the real value. If you want, I can show you an illustration based on your age, your goals, or even for a child or grandchild, and we can map out what this could look like over time. If this was helpful, drop a comment below with your questions. You can also text or email me using the information below. I'm Alex Gross with US American Insurance, and I'll see you in the next video.